Today we're going to be talking about debit spreads. So a debit spread is a directional trade. So it's basically, it can either be bullish or it can be bearish. Okay, so what it actually is an option strategy involving the simultaneous buying and selling of an option of the same class with different prices requiring a net outflow of cash, aka a debit. So what that means is you're basically buying one contract and selling another contract to get a net debit. So that way it's kind of capped out. So it's very ideal for small account growth because if you think about like naked option playing, you're usually paying a lot more money. But if you do debit spreads, you're actually paying traditionally about 50% less than actually naked contracts. The only kind of downfall is you are capped. So you have it's a pretty much a limited risk. So that's the pro. You're not really paying that much money. So you're capping your risk, but you're also capping your upside. So debit spreads, in this case, we're going to be talking about what is known as a call debit spread. So a bullish spread. Usually you want to buy an at the money call and sell one out of the money call, which thus results in a net debit. Usually it's bullish sentiment, obviously. You can have this play idea, like the structuring from anywhere from 1 month to even upwards of an entire year. I like to play my spreads anywhere, truthfully, from anywhere from 2 weeks to about 6 months. This is how I actually grew my account, was from debit spreads. They're really, really great for small account growth because so let me just give an example. So let's just say XYZ stock to naked trade for an option call is say $500. I can do the exact same spread for probably about $200. So like I can still play, in a sense, medium cap stocks while structuring with debit spreads. So just think of it as kind of like a regular call, aka like your betting is going to go up, but it's limited loss and limited profit. Whereas naked calls, you have unlimited profit potential, but you have more risk. So kind of just a couple examples of about call debit spreads before I show an actual charting of it. So you want to buy the more expensive call and then sell the cheaper call for protection. So let's just say, random example, let's say SPY is trading at $297. And the example would be you buy the 298 call and then you sell the 300 call for protection, thus kind of creating a little bit of a hedge. So that would be kind of an out the money example. So an out of the money call debit spread example would be, say, same thing, SPY's at 297. You would be buying the 300 call option and you would be selling the 302 call option. So that way it'd be cheaper. Obviously, you would have to have a little bit more oomph to actually get to your profit potential, but you can structure it both at the money and a little bit more out of the money for your spreads. So which in a sense is risking less, but you are able to make more. So the downside is if you start playing out of the money call spreads like that, it is unlikely that you will collect the full maximum profit. So usually at about 70 to 80% of your maximum profit, the spreads start to taper off. So you don't make as much money for every point the stock moves. So it's better to cut soon and quickly. So a good rule of thumb is you want to pretty much close your contracts out 3 days before expiration, because the volatility and the theta near the end of the contract isn't really worth the risk for a few extra dollars when you could go from a quick, winner to a really quick loser, super, which isn't really ideal, honestly. So I'd rather have the easy money because it's smart. I don't want to risk the extra, if I'm already up 80%, I'm not really going to risk the extra 20%, so I'm just going to take my quick profit and just peace out and just do it again and just repeat the process over and over. So also, quick tip, when structuring your debit spreads, either put debit spreads or call debit spreads, they can be either one. you want to be looking for a delta of anywhere from 0.15 to 0.30. So how to find that? You just subtract your bought contract, and then you look for that delta, and then you subtract it to your in a sense your sold contract that you kind of are selling. So this way you end up easily kind of understanding what delta you have. So good rule of thumb, 0.15 to 0.30. So then you obviously receive a credit for the sold call, but you pay for the bought call. So then you subtract the differences of the cost, and then you get what you actually pay. So a little bit more tips and tricks about it. For debit spreads, you want to, they're really ideal for long expirations, because this way, if you do like a 3-month or a year contract expiration, you're saving a lot of money. Because if you bought a year out contract for, say, I don't know, maybe let's just do Apple's contract would probably be easily over $1,000. But this way, if you structure it, for a year out with a debit spread, you're most likely going to be paying like maximum $500. Usually it's about 50% less than an actual naked position. So you want to buy the positions that you expect the price to be during that time frame. This way, it puts the odds in your favor. Monthly expirations work quite well as well, but you do not want to be playing out of the money for those. You want to be playing closer to the money and at the money for that to actually have a significant return. Debit spreads are super easy to learn. They're actually one of probably the most quote unquote basic of the spread strategies. There's a lot of different spread strategies. I can't really go over them right now because that would take too long. But debit spreads, either call or put debit spreads, are one of the easiest to learn. Just how you can kind of really quickly remember them as cap profit, cap loss. You can still close them at any time though, and take profit whenever you want. And same thing with losses. So you don't want to fully, take a full 100% loss. You can still cut these in the same exact manner as your regular naked options. You're also absolutely able to leg debit spreads together. Don't be afraid to do that, because you can prevent yourself from losing the whole position. I can talk about that in another time frame, how to leg debit spreads together. Don't want to completely overwhelm you guys. So let me kind of give an example of what a bullish position debit spread would look like. So let's just pull up AMD. So let's just say this is going to be a random example. Don't, go out and do this right now. But let's just say I am bullish on AMD. I think it's going to go up, and I already put the structure in right here. So I'm going to be buying the 108 call for October 15th, and then selling the 112 call, thus creating pretty much the hedge and the spread. So it has to be within this area by time of expiration, or by pretty much near expiration, for me to receive this profit. Now, don't be confused. Just because it says $275 max profit does not mean you're going to get that. This is what you pay up front. You pay $125 up front to open this, right? So you actually have to subtract your max loss from your max profit. So you're only getting $150 in a sense, which is still pretty good, still a 2-to-1 ratio. So also make sure the delta is where we want it to be. It has to be within 0.15. So like if it's something like this is trash. You don't want that. The risk reward is also shit. Don't do this. Delta's trash and your risk reward is trash. This is actually something that's decent, and it's something that could potentially hit. Now, what do I mean by that? So, okay, here's AMD. I think it's going to be super bullish. Now, here is where it has to pretty much be my cutoff zone. So I opened it at 108, right? So I opened it, technically speaking, the actual spread is the hedge is between 108 and 112, but you have to realize, because you're opening a little bit wider, you're opening 4-strike difference, you actually start profiting. So this is where people get confused at. You actually start profiting. If you look, you don't get profit here at 108. See, you're actually not really making much money, but you start to actually gain profit when the actual price is above 109, right? 109.40. So you have to be aware of that. Just because you structured it 108 and 112 does not mean you're automatically going to start, in a sense, gaining money at 108. So you have to be aware and look to see where you actually need to be for the cutoff region. So I already mapped this out for you guys. You have to be at least 109 to start basically, in a sense, collecting money. So it has to be by, so if let's just say fast forward October 12th, right? So I need AMD to at least be $109 or I'm going to start losing money. Like obviously if I open the spread right now, I'm still going to be gaining money. Don't get that twisted. I will still gain money. But if I'm holding this entire contract basically near expiration, I need AMD to be at 109 or I will lose money. It can be, it can be 109.50, it can be 110. That's okay. I won't make, max profit, but I won't lose money. Now, so that is where I need for the cutoff to be when I'm actually near expiration. I can still make money if I open the spread right now and tomorrow morning it opens up here, like $1.50 up. I will still be up on my contracts. Don't think just because it's not at that cutoff doesn't mean I'm going to not make profit. I will still make a little bit of profit. I just won't make that much. Now, if it's coming near expiration, this is where it's actually important that you have to be at this cutoff region, or you will then start to lose money if you're underneath this. Now, let's just say everything's going well. Let's just fast forward, say 2 or 3 weeks, AMD's doing super well, and AMD's price action's at, I don't know, let's just say it's up here over the 110 barrier and it's at like around 111. Now, this is where you start making most of your maximum profit in between pretty much the main areas. So like we have 108 and 112. You start making most of your profit between the middle ground. So therefore you be making most of your profit with between basically 110, 111. Now, once it comes to 112, your full cap out. Remember, you are capped out. Just because it's 112 doesn't mean you're going to make more money, right? So like whatever this says, so like let's just say AMD's 130, 120, right? You're still only making $275 max, but then you have to subtract your debit, obviously, so you're only making 150. Doesn't matter where the hell AMD's at because you're capped. Don't get that confused. So it doesn't matter as long as AMD stays between this 108 and 112 region by your expiration, you will make money. Now, if it's super, super bullish and, it goes, up to here and it's at 115, you will not make more money. You will not make any more money. You'll be fully capped out. Like you'll basically be making your maximum profit, but you won't make more money. So this is the one downside of spread trading, because naked options, clearly if you bought say a 109 call and the price action was at 115, you will be rewarded for that. Obviously you're going to have to pay more up front, but you have basically unlimited profit potential in a sense. Whereas for spread trading, the way you structure these, you have a capped profit potential, but the upside is you're also pretty much limiting your loss. So let me kind of just give a quick example. So let's just say 108. So I'm only paying $125 for this. So you subtract these two costs if you look, 275 and 145. So I'm only paying the difference. I'm only paying that. But if I were only to open the 108 naked call, I'm in a sense paying, double. I'm paying $275 for playing naked. So this is where this is very advantageous for for small account growth, because you can still play these type of stocks. You can still catch a decent bit of move and you're not really risking very much money. Like you're not risking very much money comparatively to, playing 108 strike. Now, you can do the exact same mentality with with bearish nature. So if this is a a bullish call, so which is known as a bull debit spread or a call debit spread, you basically, in a sense, structure your contracts to basically say, okay, well, I'm thinking a month out. What is something that's real? You have to be realistic with yourself. Don't just think, oh, I think AMD is going to go 115 up here in under a month, but you have to realize that's not really overly realistic because we have that super, super large resistance area at 110 and 112. So don't just, just because, let's just say this looks super cheap and really great risk to reward, doesn't mean you should automatically open it. You have to be realistic with yourself. So I'd like to play closer to the, especially if you're playing closer expiration, so like only a month out. Don't play super far out of the money like this. This looks great risk to reward rise, don't get me wrong, but you have to be realistic with yourself as something that actually could potentially hit. This is something that actually could potentially hit. Even if it doesn't get to 112, it doesn't really matter. Even if it gets to 110, you're still making money. Even if it gets to 19, 110, you're still making money. Doesn't have to be to 112 necessarily. So, but if you structure it kind of like this is when it basically has to get to 110. So you're kind of, in a sense, shooting yourself in the foot if it doesn't get there, because you're not really going to be making that much money, and it's not really great to do. So if you wanted to do something like that, then I'd suggest buying more time so you can do something, maybe like something like that. This would be a great spread. I would try to get it a better entry price, but this is something that potentially could actually happen. You give yourself 2 months expiration, because AMD just, went down for a large, pretty much 13% retracement, and they're on wave 3 of the Elliott wave theory. So the next real profit target is probably 110 anyway, and then 112. So something like this could actually be good for a 2-month expiration. But so rule of thumb, when playing monthly expirations, play at the money. But when playing like 2, 3, 4 months out, you can play a little bit more lenient with yourself and play further out of the money. But you also have to be realistic. Just because I'm having 2 months of expiration does not mean I can do something like this. Like, no, that looks great, risk to reward rise, but the probability of that hitting is 20% chance. And there's no way in hell I think AMD is going to make that significant of a move in under 2 months. So you have to be realistic with yourself. So that is an example of a call debit spread. So you can do the exact same mentality with bearish flow. So let's just say, all right, I think AMD is not going to, be bullish. I think they're actually going to reject off this monthly resistance of 107. So let's just say another area would be this is a support, and let's just say this is a support. So we'll structure it so this way, instead of being call bias, we're going to be bearish bias. So we think 170 is going to reject. Now here is where we're going to structure. We're going to structure it at 104 and 102. So let me see how that would look. So instead of a call, we will be doing a put. So it's a long put vertical, what is known as a put debit spread. So what did we say again? We said 104, 102. So something like that. So what this is basically saying is you need to be pretty much right at 103.29 to start kind of making actual real money. So let me kind of map that out. Something like that. So I would be structuring it between this box right here. So you can even do something further out if you technically wanted to, something maybe even like this. So yeah, that'd probably be a little bit better actually. So let's do 104, 100. And this one would be curve. So we have to be at least pretty much same thing, 103. So let's move it down. Okay. So basically the same exact mentality. I am buying the 104 put, but I am selling the 100 put. So it's basically creating the little hedge in the sense I'm not paying 244, or excuse me, 277 for my contract. I'm subtracting this and only paying 120. So my buy-in for the debit is $120. Now I subtract this from my max profit. Don't think 280 is your max profit. Your max profit is only $160. Your delta is basically right where it needs to be, right at 0.15. If it's under 0.15, that's when it starts becoming not, very ideal to take. So always look for at least a 0.15 delta, upwards of 0.30. If you can find a 0.30 delta for your spread structuring, that is great. So always 0.15 to 0.30. So just for this quick example, we basically think AMD is going to go down. We think it's going to, in a sense, reject off this monthly resistance level. And we think the profit potential could be anywhere from 103 to 100. So it has to be below near expiration. Doesn't have to be right this second. So at the current moment, it's okay if it's up here. But once it's starting to come, like a week prior to the expiration of October 15th, we need it to be at 103 or below, or we start to lose money. We have to have it at 103 or we start to lose money. So then we structured it from 104 to 100. So basically, it has to stay within this box for us to make money. Now, if it comes underneath 100, perfectly cool too. We actually get max profit, but same exact mentality. We do not make more money just because it exceeded our expectations. We are capped out maximum potential, and we have a limited downside. So same mentality, just flipped. So a good way to think about put debit spreads is a long put with some added protection, aka the short put. In case the underlying asset appreciates in value, due to the short put component part of the spread, put debit spreads are theoretically immune to changes in volatility. This makes the put debit spread a super attractive option trading strategy for markets with very high levels of implied volatility, or buying conventional puts might prove to be too costly. So let's just say your IV is super juiced, and so instead of the normal volatility of 40%, let's just say it's at 100%. Something major news is coming out with AMD. It's basically spiking the price, or excuse me, spiking the IV up ×2. So instead of your normal contract for, say, if you open only a put right here, this isn't here. So you open your put, that's usually $275, $280, give or take. Because the IV is doubled, you're actually spending more. You're spending a premium. So instead of the normal 280, you're most likely going to be paying around 350, give or take, maybe even potentially more. So this way, you want to structure a put debit spread when the implied volatility is higher than usual, because when implied volatility is higher than usual, your contracts are going to be a premium. You're going to be paying more money. Just like, as you can probably have noticed before, if you play earnings week, this is a prime example. If you play earnings week during the actual week of earnings, the stock XYZ is always more money, because the market makers think, obviously something's going to happen during this week, either up or down. There's uncertainty in the market. Market doesn't like uncertainty. Let me increase the implied volatility. So a really good prime example that I'm aware of is Amazon. During Amazon's earnings week, usually a normal contract's around, give or take, $2,000. With its implied volatility juice during their actual earnings week, they're usually about $4,000. So double their contract price. So clearly, this would be an example of where you could, put some put debit spreads on. So if you wanted to play Amazon, instead of paying $4,000, you end up paying maybe like $1,500 or maybe $2,000. But obviously, rule of thumb, you don't want to be playing the actual earnings week. You want to be playing the pre-market, the pre-earnings run-up, or the post run-up, the post continuation, because earnings week, after the announcement, the IV dwindles. So there's known as an IV crush. So always rule of thumb, don't play earnings week. It's a complete gamble. Play the run up or play the continuation. So kind of that's just my gist about debit spreads. You look for a profit potential that you think can hit in a certain amount of time frame, whether it be a month, whether it be 3 months, whether it be 6 months, a year, does not matter. Look for something that's realistic to hit. So obviously you would have to use your top-down analysis. You would have to find support and resistances, supply and demand, and then find something realistic. So clearly, if this rejects, I do think we could potentially hit 104 or 102. So the structure that I kind of structured out, the play that I structured out, is relatively okay. Now, if something that's not okay is basically something like this, there's I just because we, you know, in a sense, reject here does not mean I think we're going to go below under 100 again. So it has to obviously be realistic on both biases, calls and puts. But you can use these debit spreads. They're vertical debit spreads. They can either be call bias or they can be bearish bias. Any questions about this, guys? And to make sense on why I choose debit spreads over traditional option spreads, like if you kind of notice, when I structure my swing trading, I don't naked swing. I usually open swings with spreads because I like to reduce my risk for a very good upside, right? So the only time that I will naked play an option is if it's super cheap. Like if it's Snapchat, something that's under $100, absolutely. I'm not going to, waste, in my sense, my cap if it's something that's really cheap. But if it's something medium cap, that's a couple $100 or even a couple $1,000, this is where spread trading is very, very, very advantageous because, like I said, you're basically capping and reducing your risk, and you're spending basically 50% less than a regular naked trader. So, and you can use these in any types of market environments. You can use them in bullish market environments and bearish market environments. I can also do another segment later on, since this is basically intro to spreads. But if you kind of look here, these are some other forms of spread trading. There's a lot of different spreads that you can utilize in literally any single market environment you can think of: bullish, sideways, consolidating, bearish. Like any single market environment you think of, there is a spread strategy for it. So I'd highly recommend looking into spread trading when, especially if you are a small account. If you have a small account, this is how I grew my account. I started with $250 and I grew my account. Like, you don't need a lot of money to spread trade. You can find these plays that are super, risk reward advantageous, just because, something. Let me just do something like that. That, maybe people think that doesn't look very good, but if you're able to do this multiple times over the course of, a month, this adds up, especially for a small account. This adds up. Like, if you're starting with $250 and I risk half my account, which, yes, obviously you need to not risk half your account, but when you have a small account, you kind of have to, truthfully. I'm not saying, you can't be doing that same mentality. If you have a larger account, you cannot allocate 50% into into one trade if your portfolio is high. But if you have under a $250 account, you literally kind of have to, truthfully. So let's just say I allocate half of my account size into my $250 account. $250 account, I'm basically allocating half, and it goes in my favor. Let's just say it goes in my favor very well, and I end up making $150. I am basically, in a sense, almost doubling my account with one trade, right? So do not sleep on spread trading, especially when trying to grow a small account. So basically, that in a nutshell is debit spreads. You can use them on any expiration you want, anywhere from a month to a year. You buy positions that you expect the price to be at. during that specific time frame that's realistic. And then this way you put odds in your favor. Just to kind of reiterate, monthly expirations do work very well, but you have to be playing closer to the money so they actually kind of return well for you. And how many strikes out do you select the call above? So are we talking expiration that's a month out, or are we talking expiration that's like, say, 3 months out? Like, what do you mean, Trent? Okay, so for this specific example, all right, so I am bullish on AMD, truthfully. So let's just say if I was to actually look at this one, I'd be looking at probably maybe let me see how it would look. Something kind of like this would be one of the safest trades. Basically 108 to 110. Actually, no, I don't like this one. Never mind. The ones that we structured before is probably the best, actually, because your delta's in your favor. And this is something that's realistic to happen, because I think with the next wave up, we can hit 110, maybe even 112 within this next month. So even it doesn't have to be a 112. A lot of people think, oh, it has to get to 112. You don't have to get to 112. It has to be basically within the spread. So like, just because these are all monthly resistance and support levels, by the way. So this is clearly a weekly resistance right there on the weekly time chart. So once we break over that 107, we basically have clear sailing into 108.50. Once we break that, we have clear sailing into basically 110. So as long as it stays within over this 108 barrier, which I believe it's going to happen, this is going to be a great risk reward trade. It's a 2-to-1 risk reward trade. If max profit's $140, obviously I'd try to enter a little bit lower. I don't want to be entering right, at the mid. I try to give myself a little bit of wiggle room. If it doesn't fill, obviously that's okay. Then I'll, put the price back up. But I always try to give myself a better fill if possible. So ideally, I'd like to get fill with this. So obviously for a debit spread, you pay $125 up front, and your max is subtracted, so you only get paid 150. But this is one for AMD in general that I think would be ideal, because we have a lot of volume right at that 110. There's a lot of volume and open interest between the 106 and 110. So this is kind of justifying our trade of why we're spreading this. It does not have to be 112. As long as it's between 108 and 112, we will make money. Might not necessarily be the absolute maximum profit, but like I said before, as long as you even get 70% of this, that's all that really matters. And also, you're not losing 125. Like, this same mentality is exactly the same for naked trading. You obviously aren't going to be, cutting at negative 100% stop loss. Like, your stop loss is still going to be, in a sense, generally the same. Like, if I get into this trade and I see, next week AMD's like down here and it fell down like a couple dollars, and obviously I'm not going to be holding this. I only have a month expiration. I'm going to be cutting my loss. So at absolute most, you are going to be risking 50%. So the way that I think about it is, I'm only basically risking, in a sense, $60, give or take. I'm risking $60 to make 150. Is the way I kind of think of it, because you're never actually fully risking this $125, because you can still cut at any time you want. You can still cut for profit and you can still cut for loss. It does not have to be, you're not able to, you don't have to hold until expiration. Same mentality for naked trading. You're able to cut whenever. So you still want to have the same, in a sense, bias with your stop losses. Don't go over 50% stop loss unless you have expiration on your side. If you have conviction and you're like, oh, there's going to be a super strong bounce here and I have 6 months of expiration, sure, absolutely, hold for that. After it comes under that support, though, that you think is going to bounce at, if it comes under that support and in a sense, your trading plan isn't validated, that is when you have to cut. But if you're on a monthly expiration, you don't have enough time on your side to allow yourself to be down more than 50%, because it's kind of hard to actually redeem and recollect that full 50%. So Same mentality with stop losses, but you never want to risk more than 50%. If you want to be tighter, absolutely, you can risk 30%. It's up to you, obviously. Me personally, I will risk at most 50%, period. Let me answer another question real quick. Third question, what determines the gaps in the strikes? Yeah, so I think I might have answered your question. So you want to be looking for something realistic. So like these are all major levels. So like these, obviously, if it breaks over 1.7, then we go to 108. So I can structure it if I want to be in the money more. I could even do 107 and say maybe 111 if possible. So it's a little bit less of a risk to reward ratio, but if you want to be safer, especially for small account growth, this would probably be one of the safest ones, because clearly if it goes over this resistance of 107, we most likely have free sailing into this, and then we have some resistance at 110, 111 region. So this would also be a great structure as well. You just have to structure your strikes to pretty much realistic profit targets. Now, something that's not realistic is in a 1 month duration, I'm not going to be structuring at 115. So this is something that wouldn't be realistic. Just because it looks a little bit better risk to reward rise, well, technically speaking, this is realistic since you're spreading the entire thing. But something that's not realistic is something kind of like that. It looks great, risk to reward rise. You're not risking very much money, but you're only, in a sense, it's 20 days away, right? So it has to be above, just to even start collecting money. It has to be above 110, and just to start really collecting money, it has to be above 112. So realistic profit targets within the specific duration that you're trading. Does that make sense, Trent? Absolutely. So let me answer another question. How do you determine when to use a spread and when not to? So kind of the same exact mentality. Let's just do Tesla. So let's just do the same thing. So let's just say this isn't here. Let's just don't even look at that. So this is $2,100, right? This is $2,100. Say if you're bullish on Tesla, let me just pull it up just to kind of do an actual example real quick. Okay, let me just really quickly, let's just say I'm bullish. Let's just say this is one profit target. Well, let me get rid of all this. This is one profit target with the resistance there. Let's just say this is a different one. So let's just structure it 775 to 800 real quick. Something like that. So if you were to play, actually, let me do a little bit closer to the money. Maybe maybe something like that. Okay, something like that. A little bit closer to the money, just so this way it's giving me more of a hedge. So for Tesla, also pro tip, for larger caps like Amazon, Shopify, Tesla, you need to have a larger spread, just because you need to have larger spreads. So this way you're getting a better delta and you're not really risking that much money. So if you were to naked spread or naked call this, you'd be paying, in a sense, almost $1,700, right? Whereas if you spread it and you subtract this and this, you're only paying 1,000. Now that's still kind of a lot of money. So this is where you would be, playing around through strikes to see if something is advantageous for you that you think can actually realistically hit. Now, if Tesla is able to move $50 per day, so it's not impossible for it to hit, maybe 105. So at most I would be spreading 105, and I'd have to be above at least, say, 275, something kind of like that. Same thing here. I'd only be paying, but for this 25 different spread, 775 and 800, I'd only be paying $785. So it's, in a sense, still a 2.5 ratio. I'd be risking 785 to make basically $1,000. So this way, this is cheaper. So if you want to be playing like these larger cap stocks because you think there's going to be a massive move, because Tesla's able to move $50, just for a run up, and you're able to capitalize on these moves on a smaller account just by structuring a spread. Now, I'm not saying if your account is small, you should be playing Tesla, but I'm just kind of giving a prime example. Just because Tesla's $2,000 to play for naked, doesn't mean you have to pay $2,000 for a spread. So same mentality for maybe like a smaller cap, maybe like Microsoft or something like that. So Microsoft is, I also believe, is going to be bullish. They like to be bullish coming into the end of the year. So let's just say it's going to be maybe 305, 300, 305, something that's easy peasy. Actually, make it a little bit wider. So has to be between this spread, has to be at least over 300. And as long as it's maximum 310, we make our maximum profit. Does not have to reach 310 to make money. Just has to be within this range. So this way, instead of paying, if I wanted to play an at the money for $550, I'm only paying 385. So you're in a sense paying less money for your swings. So especially when swing trading is like, especially coming into the end of the year, like September, October, November, when the market's historically either bearish or moving sideways, you always want to reduce the most amount of risk as possible. So yeah, sure, you can, you open this for $550, or you can find a spread that, works in your favor to save money. Something, maybe I try to get something at an easier, smaller price, something like that. So it's not the best risk reward, but this is kind of just a different example of how you'd be saving money, and you would also be reducing your risk pretty much the same way. Because you can pretty much every single swing trade you think of, you can still structure it with a spread trade. Now, sometimes the risk reward might not be ideal. And when the risk reward's not super ideal, then yes, you want to be, structuring it with a naked play. But most of the times you can find a good risk reward trade with spread trades, structuring it that way, either, bullish or bearish. And this way you end up, in a sense, risking less money. So general rule of thumb is you want to put the less risk on the table as possible. Credits are basically, so in this case, you were paying a debit. You were paying a debit for debit spreads just because kind of what they're sounding. You're paying upfront. Now for